The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The stock rally hits the brakes. The gold rally reverses course, and earnings season shifting into third gear. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Here's the setup right now. A little bit of a hiccup when it comes to that risk asset rally that we were talking about yesterday. The S&P 500 still higher by about 0.1%. We were higher, and then President Trump said maybe that meeting with Xi won't happen. You can see that caused a little bit of a hurdle here. The Nasdaq 100 pretty much flat. You are seeing a rally in the bond market continue here. Marginal when it comes to the basis point move, but the 10-year Treasury yield firmly below 4%. A lot of focus on the metals today, though, as Romaine mentioned. Take a look at gold, down by 5.5%, sliding along with silver, still above 4,000, Romaine, but certainly we aren't used to seeing this in gold.
And when you look at the price action today across the asset classes, it seems to suggest we're at a bit of an inflection point for markets overall, and certainly with the S&P 500, which, despite the seeming market euphoria of late, has actually gone relatively nowhere this month. One explanation is that yin-yang between buyers and sellers that is looking a lot more like short covering rather than bullish conviction. A basket of the most shorted stocks, which includes names like Roku and Peloton, has surged 14% so far this year. But you compare that, of course, to the S&P 500, only up about 1% year to date. Now, some of this is a bit of a wait and see for the Fed, which makes its next rate decision a week from tomorrow. Some of this is wait and see on progress on U.S.-China trade talks. Some of this is wait and see on the earnings season, which, of course, picked up today with some big beat and raises from GE, GM, and 3M. We get more earnings after the bell tonight, including from Mattel, Texas Instruments, and Netflix. But, of course, we also have to get to the other big story of the day that Katie was alluding to, and that's the massive dump in precious metals. The best performing major asset class of the year sliding dramatically today. Spot gold down the most intraday since 2013. Technical indicators had indicated it had been overbought. But making matters worse, the government shutdown. No data out of the CFTC, that weekly data that will let us know how hedge funds and other money managers are positioned around that data. And without it, that means we could see, Katie Greifeld, more volatility out there. Take a listen.
If you look back 30, 40 years, gold has same kind of returns as equities, but twice the volatility. And that's what we're seeing come true today as well.
And we're seeing that volatility, of course, in commodities, seeing it in stocks as well.
Absolutely. So looking forward, of course, to digging in deeper to what's going on with gold and the metals, but also digging in deeper to earnings season. We have a big one coming after the bell in Netflix. All told today, though, you had $3 trillion of market cap reporting. GE, Coca-Cola kicking us off this morning. Then you take a look at some of the other big days, and today is just the appetizer. Coming up tomorrow, $3.4 trillion in the likes of Tesla, IBM, Thermo Fisher, and then it gets even better from there. We have to wait all the way until November 19th for NVIDIA, but as we wait, we do get, of course, an $11.2 trillion day and a $10 trillion day. So really, you talk about this inflection point, Romaine, in the absence of government data, these days become all the more important when we do actually get something to dig into from corporate America.
Yeah, and right now the connection between Wall Street and Washington is stronger than it's ever been in recent memory. And so let's kick off the show by going down to Washington right now. Sifma, of course, is the main trade organization that represents all of our broker dealers, our investment banks, our asset managers. They're having their annual conference right now. And pleased to say that the president and CEO of Sifma, Ken Bentsen, joins us right now, fresh off the stage from that conference. And Ken, I guess the big question right now is what exactly are all of these people thinking right now when you're talking to these asset managers and broker dealers and other members of Sifma? Are they optimistic about where we're going?
First of all, thank you very much for having me. Yeah, I think so. I think there is confidence from what we're hearing today from many of our panelists, economists, and market strategists, among others. There is underlying confidence in the underlying U.S. economy. Obviously, there are people watching to see what the Fed's going to do. There are people looking at what's going to happen in the labor market. But compared to the rest of the world, I think there's still a very strong support for the fundamentals of the U.S. economy.
When we talk about the fundamentals of the U.S. economy, how closely do you think that is still linked to the fundamentals that we're seeing in financial markets? Because there's been some concern about a disconnect there, given the record highs we've seen in the stock market at a time where there are some concerns about economic stability.
Well, I mean, I guess a lot of economists will say, the stock market is not the economy, and perhaps that's true. But I think, looking at earnings growth, I think people seem to feel fairly confident the market's got room to run. Again, we defer to the experts on that. But I think it's notwithstanding, various geopolitical concerns, thinking about, again, Fed policy going forward, trade policy going forward. Again, I think there's a sense that all things being equal, the U.S. economic engine is fairly strong.
And Ken, I'd love to talk a little bit more about investors. Of course, you've spoken about what asset managers are saying right now. I know that you just put out a new investor survey, basically looking at how there's a generational divide right now when it comes to investors. You have maybe the older cohort that cares more about personalized advice, and that's different from what young investors are prioritizing right now.
Well, that's right. So we put out our Vista study that we did with our partners at KPMG. That's a survey of 2,000 investors, a sample that mirrors the U.S. investment market. It was conducted in August and September. And a couple of things that came out, certainly what you pointed out about generational divide. The top lines are, strong trust for the industry, 7 out of 10, strong satisfaction for the industry, 8 out of 10. For those who have a financial advisor, very strong satisfaction in the 90th percentile. But you're right, as you go down the age to, the generations to the Gen Z, the focus is really there more on focus around technology, digital technology, and transparency. But again, we do see that there are demands for financial advice, but just doing it in a different way.
It's interesting, I mean, to hear what you're saying and taking the results of this survey, basically against the backdrop of you have the rise of the self-directed investor who isn't necessarily looking for advice from a formal financial advisor, who isn't necessarily turning to products that asset managers can create, but instead, they're doing things by themselves. They're basically going into brokerage platforms and making the trades by themselves. And you also have the rise of prediction markets. And I wonder, how asset managers are thinking about that question today, about how do we basically appeal to the self-directed investor and work with them?
Well, of course, we've had self-directed markets, as you know, for decades now. And what we're seeing are more and more hybrid accounts where there's an advisory component and a self-directed component. And I think what the survey shows is firms are going to have to think about that of their offerings, that they can fund, that they can provide that hybrid approach. And then most importantly, for younger generations, how you communicate, even in providing advice, is going to be different than perhaps our parents did with regular interaction with a financial advisor. But what we do see is across the board, there is demand for financial advice. So we don't think everything is going fully do-it-yourself, self-directed, but you need to be you need to be able to offer those all of those platforms, which the industry largely does. But you have to go to where your client's going to be.
Has there been any sort of meaningful discussion, Ken, about what we've talked a lot about on this show, at least, which is the democratization of access to alternative assets? The idea that a lot of these real assets, alternative assets that were sort of confined to institutions and high net worth individuals, we're coming down on that income spectrum right now. And there has been some concerns about what, if at all, changes would be needed on the regulatory side.
Well, absolutely. I mean, we know the Department of Labor, which oversees 401ks, is looking at how you can expand access to alternatives and defined contribution plans, like defined benefit plans already have. The Securities and Exchange Commission Chairman Atkins was at our conference this morning talking about this, of how can we look at where retail investors can have access to products that heretofore were really the purview just of institutional and high net worth investors. But in every case, at the same time, how do we do it in ensuring that we maintain our investor protection rules that are so important to the U.S. market system, and making sure that we address things like valuation, transparency, liquidity, which are things we at Sifma and the industry are working on as well, as policymakers consider thinking about ways that can accommodate more individual investor exposure to alternative assets.
Ken, always great to catch up with you. We'll let you get back to it. Ken Bentsen there is the president and CEO over at Sifma, which is having its annual conference today down in Washington, D.C. When we come back, we turn back to the markets and we turn back to a big shakeup over at Novo Nordisk, getting rid of 6 members of the board, the chairman out, what this could mean for the pharma powerhouse. That conversation when we come back right here on The Close on Bloomberg.
And from company shakeups to market shakeouts, we'll also discuss, Romaine, gold's wild ride and what's next for the commodity space with Natasha Kaneva. She is head of global commodity strategy over at JPMorgan.
And then it's lights, cameras, earnings, full coverage of Netflix results after the bell. Sarah Kunst over at Cleo Capital, Michael Pachter over at Wedbush, Mark Douglas at Mountain, just part of the big lineup here that's going to help us parse those earnings. Don't go anywhere. This is The Close on Bloomberg.
A leader shake-up at Novo Nordisk, rattling shares of the Ozempic maker. The chairman stepping down along with 6 other board members following a disagreement on how quickly the company should adapt after falling behind U.S. competitor Eli Lilly. Joining us now is Jared Holz. He is healthcare equity strategist over at Mizuho Securities. Jared, great to have you with us. So beyond the CEO, which of course we saw a change there, clearly a shakeup still underway at Novo, but when you think about what they're dealing with, the competitive landscape and how it shifted, I mean, how much is reshuffling the board leadership and the board itself going to help them compete here more effectively?
Thanks so much for having me. I mean, it's a step in the right direction if the whole concept here is to sort of, light a fire under everyone at the company in what has become obviously a very competitive market. A year ago, a year and a half ago, Novo seemed like the best positioned company in the weight loss space, and you kind of fast forward to now, and now they're having to play catch up. I mean, there's a whole host of reasons why, but I think, on the surface, shaking up the board probably, eliminates what has, many have described potentially as complacency over there, and we'll see what happens.
And you think about what they need to adapt to right now. I mean, what will help them sort of level the playing field with Eli Lilly, that is? You think about some of the things in the pipeline that are to be expected in the coming months and years when it comes to orals, for example. I mean, what other cylinders can they try to fire on here?
Well, I think the oral obesity pill is going to be, a big factor for the company over the next year or so. We'll see how those launches go. I think the market's really excited to see, both companies and how that entire market unfolds, because the patient numbers are so massive that could easily be a $50 billion plus category. They're also working on other weight loss treatments, including an amylin plus the GLP, and they just did a $5 billion deal for Akero a couple weeks ago to get into the liver space. So they are kind of making some progress, but maybe it's just a little bit too late. Obviously, the stock has done what it's done, and now they have to get on better footing.
I am curious, Jared, just about when we talk about this idea of having a management team and, for that matter, board oversight to sort of facilitate a faster transition. I guess the question is, how do you do that if you don't actually have those people in place yet?
Well, obviously, I think the significance of the headlines today is that the leadership of the Novo Nordisk Foundation has been obviously not satisfied with what has gone on the company. So you would imagine that whoever they bring on is probably going to be, just a little bit more fast-paced, see some more urgency, and really just put the company in a different direction. And, is definitely as far as speed, because, we've seen a lot of things happen around this obesity market that I think have probably caught Novo by surprise, at least to some degree, based on where they were a couple of years ago. But not knowing exactly who is going to be in the seat is a very good question. No one knows, but you would suspect that they're going to bring in people who are, holding the management team and the employees more accountable.
I am curious just geographically about the selection process of sort of who they want at the helm. I know they have the new CEO, an insider. But it seemed like there are a lot of issues that Novo was having were basically either, I don't want to put too many words in their mouths, but kind of a lack of understanding of the U.S. healthcare market or the North American healthcare market. And I am curious as to how you address that by just putting other folks from their home country in charge. No offense to them.
Right. I mean, you may not. It may just be more, generational or getting, members of the board who have experience, potentially on boards of other companies that are closer to the U.S. market. I'm not really sure this is not an understanding of the U.S. market necessarily. I think for all of us, this has been a very difficult market to call because it's so much more consumer facing. I think this obesity space is much more of a consumer market than therapeutic. That's probably something that they might have seen some missteps along the way as well. So we'll kind of find out as we move forward here.
All right, Jared, really appreciate you taking time for us. Another great note out of Jared Holz, healthcare equity strategist over at Mizuho. We should point out Novo's ADRs here in the U.S. down about 2% and down more than 30% on a year-to-date basis, of course, after being one of the hottest stocks back in 2022 and 2023. When we come back, we're also keeping an eye on shares of Netflix, scheduled to report earnings after the bell tonight. What to expect? Stick around. That's coming up next here on The Close. This is Bloomberg. All right, time now for our top calls. Big movers on the back of analyst recommendations. And we start off today with Capri. That's the parent of Michael Kors, Jimmy Choo, Versace. Well, Raymond James is upgrading to outperform, saying business is improving sequentially, and the next earnings report should come in, quote, above expectations. Those shares up about 5% on the day to their highest since March. Next up, Cleveland Cliffs, Wells Fargo, cutting the steel producer to underweight, the price target at 11, the downgrade coming after yesterday's earnings beat and that rare earth minerals announcement, which led to a 22% rally in the stock that the analyst says looks unwarranted. Those shares down 17% and now pretty much back down to their levels from Friday. Finally, Warner Brothers Discovery, Benchmark raising its $18 price target to a street high matching $25 on the news that the media giant is considering a sale. The analyst names Paramount Skydance as the best positioned suitor, saying David Ellison's new company, not Netflix, offers the best strategic value in tandem with a high likelihood for regulatory approval. Those shares having their best day since mid-September, and those are our top calls. Now, speaking of Netflix, those shares have been moving slightly higher here on the day ahead of its third quarter earnings report scheduled to come after the bell tonight. Matt Dolgin joins us right now, senior equity analyst over at Morningstar, to discuss. And Matt, I mean, you've been relatively bearish on Netflix for some time. I am curious as to what exactly you want to hear from them out of this report and that conference call or whatever we're calling that thing later tonight.
Yeah, well, our valuation call or our fair value estimate is really just based on valuation. So it's not that we're necessarily bearish on Netflix as a company. We think it's the best. We think that the growth expectations in the stock are too high. And so the way that we model on a long-term basis with a discounted cash flow, that's where we come out at our $750 fair value estimate. As far as what we're looking for tonight and what we'd be looking for to maybe change our view and raise our forecast a little bit, I think it's pretty clear that it's going to be a really good looking quarter. Based on the number of subscribers the company added in the fourth quarter of last year and the price increases earlier this year, we know growth is going to be high. They're looking at about 17% overall sales growth. That was our guidance. So we'll see which side of that they fall on. We would expect they'd meet it. Although last quarter they met their guidance really just because they had a currency tailwind, which we expect will be the case again, and we'll see if that's what it's riding on. Underneath the earnings, we're really looking closely at the U.S. because that's a big reason why we think the company's growth is going to have to decelerate over the long term, and why we don't think the company's going to meet maybe what the street is looking for over the next few years. If the U.S. grows more than 15% on the top line year over year, that would be a positive indicator because it would look like things are accelerating a little bit from last quarter. The company may be adding subscribers, finding a way to squeeze even more revenue out of users, potentially with more advertising, with those price effects having taken effect in the first quarter.
Right. Well, Matt, I hear what you're saying on the U.S. Let's talk about the rest of the world. Let's talk about international. And potentially the growth opportunity that Netflix has there? Because some folks have made the point that you think about Netflix in the U.S., maybe that market is saturated, but where does that leave the rest of the globe?
Yeah, and so that is our view on the US, and we do think that there is a lot of subscriber pickup opportunity over the rest of the globe, Asia Pacific in particular, but really in many markets. The issue that we have with that is not that they'll add lots of subscribers over the next few years, which we absolutely think they will. It's that those are lower priced markets with probably less opportunity to raise prices. So when you look at the mix of what revenue is going to be and the ability for those markets to be the primary drivers of overall top line growth, because remember, the US still makes up about 45% of overall revenue. And that, in our view, is the reason why the stock has been in such favor the last couple of years, because the U.S. was really outperforming. If sales for this company are led, or if sales growth is led by the international markets, we think it's going to have a tougher time keeping up the rate that it's had. And so while we do think there are big pickup opportunities for subscribers, we don't think it's going to drive the same top line. And it also could inhibit the ability to expand margins as much as the company's been doing.
Hey, Matt, so I do have to ask you about a lot of the speculation that's been going on in the market surrounding Warner Brothers Discovery, and whether you think Netflix, A, would even be interested, and if so, do you think it would actually be a good fit?
The answers are yes and yes, in my view, although the caveat is Netflix would really only be interested in the streaming and studios business of Warner Brothers Discovery. So Warner is planning on splitting those businesses, streaming and studios, from linear networks next year. Netflix would definitely, in our view, benefit from having that streaming and studios business, having all of the library that Warner has, the premier studios that Warner has.
Yeah.
As far as whether it would be interested, it would be an acquisition, even just for that side of the business, much bigger than it's ever done. So I think it would make sense. I think that they could get that merger through. There shouldn't be regulatory hurdles for Netflix with that business. But whether they want to take that big a bite, I wouldn't necessarily predict it.
All right, Matt, got to leave it there. Great to get some time with you ahead of Netflix earnings after the bell today. That is Matt Dolgin. He is senior equity analyst over at Morningstar. Now, coming up, all that glitters may not be gold as the commodity slides today. Up next, we'll speak to JPMorgan's head of global commodity strategy, Natasha Kaneva, for her outlook. That conversation up next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifel. Just 30 minutes to go until the bells ring, and we care about the stock market, but
we do.
We really care about commodities right now as well.
We do, absolutely. And the big reason why we care is because they are down dramatically. At least the precious metals are down dramatically. The drop that we've seen today in gold is breathtaking. I think at one point it was like the worst day intraday going back to 2013. But you kind of have to overlay that with this huge run-up that we've seen in gold prices now for the last few months. And a lot of people are asking what was actually driving that. And I guess that leads to the question of what's actually leading to the pullback today.
Exactly. And I mean, even with this pullback that we're seeing today, we're still above 41,000 or 4,100. That is,
wow.
41,000. I mean, the way we've been going, I think
like
you
a
could map it out there. But 4,100 per ounce, of course, a few months ago, even that would have been really hard to believe. Let's discuss further with Natasha Kaneva. She is head of the global commodity strategy team over at JPMorgan, sitting with us in studio. So I know that one day it's important not to pay too much attention to a single day of action, but what do you think is behind this big drop? Is it just technical, or is there something else going on?
Oh, I think, first of all, we need to put this in perspective. As you said, the drop today was breathtaking. It's the biggest in 2013, but at the same time, the rally has been enormous, yes? And I would like to put some numbers there. So the Bretton Woods falls apart, and the U.S. retail investors are allowed to buy gold. That was 1975. Gold was trading at $35 at that time. To reach the first 1,000, it took us 38 years. Yes, that was 2008. The second 1,000, from 1,000 to 2,000, it took us 12 years. The third 1,000, which was, by the way, March of this year, it took us 4 years. And between the end of August and a couple of days ago, we moved $1,000 in 60 days.
Wow.
Yeah.
So the rally was breathtaking. So it's too far, too fast. We need time to breathe. We need time to digest all of that. So this is healthy. We believe that this pulse right now is healthy. What is not healthy, the current volatility. As 2 days ago, gold was down $80. Yesterday was up $150. Today we're down $250. This volatility is unhealthy.
I'm just curious, though, on that recent run-up that we had over the last few months, do you have a sense of who was actually buying that?
Retail investors.
It was retail
investors. So the rally started in 2022. That was the central banks. Yes, we discussed this with you guys. This year, it was pure ETFs, retail investors, to some extent institutional investors, because the central banks definitely took a breather this year. So they bought less at what they bought in the previous 3 years. ETFs, however, massive amount of buying. They have been selling over the last 3 years. Year to date, through the middle of October, they purchased about 700 tons. The peak purchases was in 2022 at about 890.
That's a good point. You know, when you come to the central bank story, that has been building over the past couple of years. But you take a look at ETFs such as GLD, for example, just taking in billions and billions of dollars year to date. And I want to go back to what we're seeing today. I hear what you're saying, that we went too far, too fast. It seemed inevitable maybe that we were headed to a pullback. But I just come back to why now? Why today? I mean, is it just, you know, you have Diwali going on and a huge liquidity pullback with India being on vacation here, or is there something else going on?
So to some extent, it could be the silver, because we noticed the sell-off started in silver. At some point, silver was down $9%. So it could be that, you know, the silver started the story, and after that, you know, there were news about Diwali and other things. Indian demand actually continues to be very strong. We do believe that the Chinese will be back in the market just because the arbitrage now, the premium of the Chinese price is moving from deficit into the premium. They will be back in the market. Yes, could be as simple as that, you know, silver started, gold took off.
Yeah, I'm just curious, but before we move on to some of the other commodities, I am curious about some of the industrial metals.
Yes.
And because we had seen a lot of activity there for a while, and I know that's kind of tempered down here. Do you actually see a potential for a meaningful uptick in some of those metals, primarily like copper, aluminum, et cetera?
So last week was the LME week, the London Metal Exchange week. The feedback we're receiving from that is that everybody came back very, very bullish on copper. You know, some of the price we're hearing like $12,000 to $15,000 over, you know, 2026, 2027. It does appear that the story is exactly as we have been discussing that many times, is that demand is there, supply is not.
And you know, I just keep coming back to the point that retail investors have been behind a lot of the moves that we've been watching with gold. Have they moved into some of the industrial metals? It's not a natural place, you would think, commodities for retail investors.
We see very, very limited interest to none from the macro investors in copper and other metals at all.
I think it would be great if copper became like a meme stock in the same way. Natasha, I do want to ask you a little bit about what's been going on with oil prices. I know they've kind of been a little bit of a standstill as of late, but there's been some discussion here that maybe we could see a bump in prices if there is a resolution to what's been going on with Ukraine and Russia. Do you see any sort of potential for that to actually be an upside catalyst for oil prices?
Downside catalyst if there's a ceasefire. If there's ceasefire, you would assume that there will be some type of a downside catalyst. We don't believe so, because at the moment, everything what we're observing is that Russia continues exporting everything they're producing. Russian production is actually up. They're increasing oil production despite everything that is happening with their refining sector. Production is up, exports are up very, very strongly. So they have not cut any production because of the war in Ukraine. So if there's a resolution, or when there's a resolution, rather, hopefully, we do believe that there will be no impact on the oil price.
So if you add it together, though, I mean, when it comes to a potential resolution being a downside catalyst, do you think about the supply side of things, Russia production increasing? I mean, where does that leave oil in 2026? Because that seems like a lot of downside catalysts being piled on top of each other.
Yes, so we actually reached our price target, $61 for the fourth quarter. So we're here. For 2026, we see prices averaging Brent, $57. So WTI 55. It's a low. As a commodities analyst, this is not the price I would prefer to see in my model. We're getting to the level now that we started, you know, to think, what does it mean for the U.S. production and all other things. There's a lot of supply. Supply is growing at 2.5 times the pace of demand.
Just remind me, so when it comes to U.S. producers, what is kind of the price threshold that they keep an eye on that's kind of the danger zone?
So we are keeping an eye on 48. 48 WTI. This is a cash flow neutral price, which means the return is zero.
Yeah.
So everything what we are hearing from the Dallas survey, 65 or above that assumes about 20% return on investment. That's not what you start thinking about cutting production. 48 is the red line we're watching.
So same question, but through the lens of the Saudis and OPEC.
Oh, Saudi cost of production is $8.
Okay. All right. So that's not really a factor for them right now.
Even Brazil, $5.60.
Yeah.
22,000 feet deep. That's what they're drilling in the water, $5.60.
Wow. All right.
It's the U.S.
Natasha, always insightful. You always come with the data. We always appreciate talking to you.
Thank you. Thank you for having me.
And Natasha Kaneva is head of the Global Commodity Strategy team over at JPMorgan as we keep an eye here on the big moves today to the downside in those precious metals like gold and silver. Meanwhile, we're going to take a look at one of the big movers to the upside. It's a penny stock. It didn't used to be a penny stock, but it's gotten some newfound retail interest. Beyond Meat, maybe potentially the next meme stock?
Wow.
Apparently there's somebody who wants to replicate what Roaring Kitty did with GameStop. That conversation coming up after the break. This is Bloomberg. All right, our stock of the hour is, well, what else? Beyond Meat. The shares as of right now are up 147%. Fueled by a retail trader that seems to be going for a GameStop-like short squeeze. A new distribution deal with Walmart also helping those gains as well. Norah Mulinda joins us right now to talk a little bit more about this. And you saw the two-day gain up there on the screen. For a stock, we should point out, this stock was valued at a lot more. It's basically been trading as a penny stock for a while. I'm trying to understand, though, other than just pure speculation, is there a fundamental reason why we're seeing so much interest in this? Have we all gone vegan again?
Well, I certainly haven't. I'm not sure about the rest of everyone else. But I mean, I do think that this deal with Walmart is a really big push for the company. As you mentioned, that used to be trading pretty nicely, but then fizzled out. So you are seeing a run up today that's had the stock add more than $1 billion in market value just in today's trade. So you are seeing a lot of things exchanging hands right now, soaring as much as 161%. But also of note, we had Roundhill Investments. They actually added the stock to their meme ETF. It's ticker MEME, so very fitting there. So we are seeing shares getting a pretty welcome boost right now as all the retail traders are really hopping in here.
Yeah, it's just wild. For context, though, I will point out, it hit a high, the share price of $192 all the way back in early 2021. We're trading at about $3.50.
Oh, it got higher than that.
So what'd you say?
It got over $200 back in 2019.
Oh, well, that's on an intraday basis. I'm just looking at the closing basis.
Intraday.
Until those bells ring, it doesn't matter. But Norah,
it also had an IPO at $25 a share, which so it's trading at $3.05. So
back
it's got some ground. It's got some ground to make up.
That's volatility,
absolutely,
to put it mildly. But Norah, talk to us too about the potential positioning factors here, because a few folks have said this looks like a short squeeze. But what do we actually know about how much short interest there is in this name?
Yeah, I mean, I think that's something you really have to keep an eye on, especially as you think about a lot of these highly volatile names. If you look at any sort of meme stock, there's going to be a lot of essentially some sort of possibility that there could be a potential short squeeze. You see a lot of people pouring money into names like this, and then only for it to further decline, you see people being squeezed there. So that's what a lot of people are looking at here in particular for Beyond Meat here. So it's something to keep an eye on. But I think also to that, a lot of sources are talking about the idea of this being a potential frothy market signal. And that's been the discussion that's been on a more macro basis that's also being a bit underscored here with Beyond Meat.
Well, that's what I'm curious about, too, is about the durability of a rally like this. I mean, it's easy to say, OK, look what Roaring Kitty did with GameStop. But that was such a different time. I mean, we were all locked in. A lot of people didn't have jobs. They had stimulus checks. They had all the time in the world. You know, I think most of us have gotten back to our regular lives. And I'm sure there's still some people who just want to, speculate on whatever this is. But the question is can you get enough people on board? This guy, that Business Insider profile, enough people on board to really sort of boost this stock in the same way that GameStop, because that was not just a 1 day, 1 week type of event. That was a couple of years.
But we are seeing a lot of the more recent meme stock mania fizzling. It doesn't seem to last as long as the likes of GameStop that we saw back during the pandemic. So it really is important. You see a lot of people going to social media to really garner a crowd and get people going. But if you just think back to July, what we had another quasi-meme stock revival between Open Door Technologies. We had GoPro. There's Krispy Kreme donuts even. And so
is
beyond.
coupons still a thing? I think that should be the next meme stock.
You know, hey, maybe they'll catch on to it.
I did a few Groupons in my day, but Romaine, I kind of agree with you. I do think it's amazing that, we have hiked interest rates up to the levels that, above 4%, and still the phrase meme stocks is still in the vernacular.
I thought financial conditions were tight.
Yeah, well,
That's
then
what
you
we were
take
told.
a look at what's going on here, and there's a different.
So when the
argument to
Fed
make.
goes into that 2-day meeting, which starts 1 week from today, is someone just going to bring them in some
They
stock
don't
charts?
have any government data to look
Okay.
at, so maybe they'll be taking a look at the meme
We shall
stock.
point
might
out,
have to.
On a related note, we should point out Krispy Kreme, for reasons unknown, is up about 16%. So
Well, there
you
you
need to go
go.
back to your desk and find an explanation for that as well.
Right. Let's see what Dunkin' Donuts is doing, right?
Yeah, we'll let you go through that. That is Bloomberg's Norah Mulinda reporting on meme stocks, which still exist.
When was the last time you had a Krispy Kreme donut?
Not really my bag. I do love donuts, let me say that. Krispy Kreme, though.
Who doesn't love donuts?
I don't know. Anyway, the closing bells are up next. We'll take you there with Joe Tanious. He is Chief Investment Strategist of North America over at Northern Trust. This is The Close on Bloomberg.
People seem to feel fairly confident the market's got room to run, notwithstanding various geopolitical concerns, thinking about, again, Fed policy going forward, trade policy going forward. Again, I think there's a sense that all things being equal, the U.S. economic engine is fairly strong.
U.S. economic engine is strong, and so too are financial markets. Ken Bentsen, president of Sifma, kicking us off to the close just about 50 minutes ago, Katie. And while it doesn't look like we're going to hit any new record highs today, at least not for the NASDAQ or the S&P, it does look overall like we still have some stability out there.
Yeah, absolutely. You take a look at the S&P 500, higher by a tenth, maybe 0.2% if you're optimistic. In terms of what isn't doing too hot today, you do have NVIDIA and Broadcom lower. We did hear from President Trump maybe throwing some cold water on whether or not he would meet with Chinese President Xi Jinping. The last time that happened, it was a much bigger reaction. So the fact that we are finishing in the green maybe speaks to the resilience of this market. And then take a look at gold, Romaine. I mean, this is what everyone is talking about today. Just this big slide that you're seeing in the precious metals.
Although, sort of pick up on where Natasha Kaneva left off just a little while ago, a 6% drop after what, 100% move higher.
Perspective is
more
important.
as the perspective is move. $1,000 added just to the price of gold over the last few months. So maybe some profit taking, maybe something a little bit more technical. And of course, we have an eye on earnings as well as we wait for Netflix after the bell tonight. Joe Tanious joins us right now, Chief Investment Strategist of North America at Northern Trust. Great to have you here, Joe.
It's great to be here.
I do want to start off with just kind of what Ken Bentsen was getting to, and this idea of relative economic stability, relative strength in financial markets. But we're still seeing some degree of skittishness about whether we might have actually reached the end of the rope here or whether there's still some life left in this bull market.
I think that skittishness is healthy. But remember where expectations were on Liberation Day. I think consensus was calling for softer economic growth. The prevailing view was that the U.S. economy was going to enter a recession. Everyone's been, for the most part, wrong with respect to these tariffs and the impact that was likely to have not only on economic growth, on inflation, on profit margins. So resiliency is the word I think you both use, and I think it describes the U.S. economy quite well. Are there areas where we should be concerned? Absolutely, absolutely. But I think overall, it's been much, much better than feared.
I am curious, though, about the complexion of the market, particularly over the last month, because, I mean, there were some fundamental reasons why we saw that big rally, and obviously political reasons as well. But over the last few weeks, and I have to give a hat tip to Jess Menton, who runs our equities coverage here at Bloomberg, she pointed out how the most shorted stocks are really the ones that have outperformed over the past few weeks. By far, by a multiple of 10 to 1 relative to the benchmark indexes. And I'm wondering that when you look at that, you look at a Beyond Meat rallying 100+%, Krispy Kreme rallying 20% here on the day. What does that tell you about investor sentiment right now?
Well, it tells me, one, that I want a donut when this segment's over. But I think, what you're getting at right here is just this overall investor sentiment and this FOMO to an extent, right? Which we talked about a little bit at the break. But you think about what's really driving the economy, what's driving markets, and you have a little bit of this a rising tide lifting all boats, if you will, and I think that's probably what's driving some of these more speculative names. But even if you put aside some of this this enthusiasm, if you will, which has been driving the more speculative side of the economy, the underlying fundamentals themselves, which we talked about or briefly talked about, are actually quite strong. And we can look at earnings season, we can look at the underlying economic data, we can look at consumption, despite the fact that, of course, we don't have official economic data, right? When you take a look at some of the private sector data that's been released and you triangulate what's happening in the economy, again, resiliency is probably the best word I can use to describe it.
You know, it's time now for our personality test.
Oh,
What's your favorite donut flavor?
Oh, favorite donut? Plain.
Okay, you pass.
You know, me too, Joe. I was going to say plain. Yeah, just a plain Krispy Kreme. That's what I would pick if I were confronted with the choice. But, Joe, let's actually go back to the reason why we're not getting the underlying economic data. We can't dig into it. The government is still shut down. And for a lot of investors, that has felt like sort of a sideshow. And I wonder, you know, how you're viewing the developments in Washington or the lack thereof.
Yeah, well, we're on day 21. I think if my math is correct, we're on day 21. Every day there is a headline, there is a rumor that maybe, just maybe, we're getting closer and closer to finding a deal, to someone sort of budging. Yet at the end of the day, those rumors are effectively dispelled. Everyone is effectively just digging in their heels. And I think, unfortunately, that's where we are. Right or wrong, good or bad, I believe market participants are becoming a bit immune to this and they're becoming numb to this. Now, it hasn't affected the underlying economy yet, we don't think, but certainly the longer this goes on, it affects consumer confidence, it affects investor sentiment, it erodes confidence just in our own political system, in our own economy. And then you also have to think about these individuals who are not receiving their paychecks. You know, I was at the airport just yesterday, and I'm chatting with some of these TSA agents. I feel for them. One, it's a thankless job to begin with, right? It's not an easy job dealing with people day in, day out. But then on top of that, they're not receiving their pay. So I think the longer this goes on, this has the potential to become much, much larger. But fortunately for now, it hasn't really happened yet.
Well, Joe, to that point, the longer this goes on, you'll start to see the effects actually manifest. I mean, is that investable? You think about sort of the fundamentals of this economy, of corporate America. Maybe we start to see this impact the economy a little bit, but is that something that you would, you know, switch your allocations around?
No, I don't think so. I think largely what we're looking at is noise. At the end of the day, if you have all of these employees that are furloughed, and we're not talking about permanent layoffs, which is a whole other can of worms, if they are furloughed, what you end up with is back pay, which eventually goes into the economy. So the net effect of it from an economic perspective is somewhat muted. Not to downplay how disruptive it is, certainly, but I think markets have a tendency to look through it.
We only have about a minute left, but I mean, we don't have the economic data, but we still get corporate earnings, which in a lot of cases can be almost as good as economic data. After the bell tonight, it's like Netflix, Capital One, Mattel, a few others. I'm forgetting, Texas Instruments. I know we're still early in this earnings season, but are you relatively encouraged by what we've heard so far, and what are your expectations for the rest?
I am encouraged by what we've heard so far. If you think back to second quarter, expectations were kind of at a basement level of 6%, and earnings basically came in and doubled those expectations. Heading into this earnings season, I believe consensus was hovering at around 9%. I think we're probably going to exceed that. Overall, corporate America continues to look pretty good. There are a few themes here that we continue to see playing out. It is this K-shaped economic recovery. Right? We talk about consumption. We talk about the higher income quintiles versus the lower income cohorts and that discrepancy we're seeing there. You also talk about the AI trade and sort of AI spend, which has been dominating the economy and driving the economy forward. I think that's going to play out in the earnings data as well, and something we're going to keep a very close eye on.
Joe Tanious, have to leave it there. Great insights, Chief Investment Strategist of North America over at Northern Trust. As we count you down to the closing bells, just about 2 minutes to go, and S&P clinging to modest gains on the day. A second straight day of gains if this holds, with a slew of earnings coming up after the bell. A full breakdown of what happened today and a full breakdown of those earnings starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with the global simulcast. It's already started. There's Carol Massar. There's Tim Stenovic. Welcome to our audiences across our Bloomberg platforms, television, radio, our partnership with YouTube here on a really volatile day, at least in some asset classes. And after the bell tonight, Carol, we get a slew of earnings, including from Netflix.
Well, you talk about some of those asset classes, precious metals, right? We've seen silver and gold, a big pullback in today's session. We just had a guest on. We were talking about, just taking a little money off the table, but still thinking that that is still a good trade for investors.
Netflix, certainly the star of the show in the next few minutes, but don't forget, we're still looking at what's going on with regional banks. Western Alliance is reporting at 4:30. We're going to have those numbers for you. We did hear from Zions yesterday that maybe helped to, lessen some of the concern that folks had about it being less idiosyncratic and more systemic when it comes to risk for these regionals.
Absolutely. I mean, you can see that in shares of Zion rising another 1.6% today. You can see that, too, in shares of Western Alliance rising 1.5% in anticipation. But really, again, it all comes down to Netflix.
Yeah, I do want to point out, though, too, I mean, so far this earnings season has been good. I mean, we got the banks, but then I don't know if you saw this morning. I mean, a beat and raise by General Motors, a beat and raise by General Electric, a beat and raise by 3M. So you're getting a lot of these companies that, no offense to Netflix, that are probably much more reflective of economic conditions. And at least for right now, they seem to be doing well.
A broadening out, right? We always say that that's important in the marketplace, certainly in the trade. Also good to see that in earnings remain.
All right, let's walk you through the daily numbers here as we wait a slew of earnings across the wire now that we get the closing bells. I'm going to start with the Dow Jones Industrial Average because that is going to close decidedly in the green, up more than 200 points or about 0.5%. The NASDAQ Composite down 0.2%. The NASDAQ 100 down less than 0.1%. And the S&P 500, it takes a while for these numbers to settle, but we're just going to call it unchanged on the day, right around 67.35 and change. The Russell 2000 down 0.5 percentage point.
All right, quick check on the S&P 500. Not quite an even split, a little bit more to the upside. 299 names, Katie, gaining ground on this Tuesday, 202 to the downside.
Which is interesting because you take a look at the sectors. You had more sectors that were lower on the day, 8 to be exact. Only 3 sectors managing to finish in the green. They were consumer discretionary, industrials, and healthcare. What didn't do too hot today is utilities, communication services, and materials. But still, overall, the S&P 500 unchanged.
Yeah, interesting, right? To see that it almost is like we were waiting for a few things, like earnings, whether, we get that inflation report on Friday, looking for some more clarity about kind of what's coming at investors and certainly what it might mean for Fed policy.
All right, we are getting those Netflix earnings crossing the wire right now, so let's dive into them. Texas Instruments also crossing the wire on Netflix. I'm going to start with the guidance. The company says that for its full year, it sees revenue of $45.1 billion. It had a previous range of 44.8 to 45.2, so basically guiding towards the top end of that range, but maybe just a smidge lower. Now, here are their results for the third quarter, their fiscal third quarter. Free cash flow was a beat, $2.66 billion. EPS was a beat. I take that back. EPS was a miss, $5.87 a share. The street was looking for $6.94 a share. So a miss on EPS. On the revenue side here, it also looks like they came in a touch light, $11.51 billion. The street was looking for $11.52 billion here. And of course, we don't get those subscriber metrics, but overall, the two metrics that they really want us to pay attention to with regards to revenue and with regards to bottom line EPS, it looks like a modest miss in the most recent quarter and a modest guide to the top end of the range for the rest of the year.
Well, you can see the disappointment in Netflix shares right now, down 5.5%. We'll dig deeper into that, but let's take a quick detour to what's going on with Texas Instruments right now. Another miss when it comes to third quarter EPS, missing estimates coming in at $1.48 in the third quarter. The consensus had been for $1.49. When it comes to fourth quarter revenue, the guide there is for $4.22 billion to $4.58 billion. The estimate had been for $4.5 billion. So a range there, you average that and it comes in at the low end below that estimate. So you can see Texas Instrument shares down about 4% in the after hours trade. Also down, Netflix continuing to watch what's happening in the after hours, down about 7.3%. Our own Lucas Shaw out with his first take on earnings, writing that a tax dispute with Brazil cut into third quarter earnings. It mars results that otherwise fell in line with Wall Street estimates. Netflix had to pay about $619 million to settle a multi-year tax dispute with Brazilian authorities going back to 2022. But the company said it would have beaten forecasts if not for that expense. Shares down just about 5 points.
0.75%.
Yeah, I mean, keep in mind that this stock has been certainly an outperformer this year, up about 39% year to date. But again, the big headline in terms of the outlook, Netflix seeing fiscal year revenue 45.1 billion, had seen about 44.8 to 45.2, so a bit of a range, but that number below the higher point of that range remain.
You know, I always like to look at sort of, they talk about their content and some of the big hits that they've had. Of course, a Happy Gilmore, which is one of their more successful, at least in terms of streams in the most recent quarter. My Life with the Walter Boys and Hunting Wives and a few others. But it gets to this idea here that assuming that we're not actually being able to see what those subscriber numbers are, the question is, how is this actually adding to the bottom line? How, in fact, is this adding to the top line? And that's going to be a big question for, I guess, the one analyst who's allowed to ask questions on that conference call.
Yeah, absolutely. Have to imagine it's made that man's job a little bit more difficult here. You dig into some of the international markets as well. This is what we had been discussing with an analyst over from Morningstar, that when it comes to the growth opportunity, there's a lot of focus on international. It seems like when it comes to Latin America, when it comes to APAC, revenue there falling a little bit short of expectations for both of those regions. The U.S. and Canada and Europe did manage to just slightly beat expectations. But again, it's where you expand to next. Is the U.S. market saturated? That's also one of the big questions here.
What does the content slate look like, too, especially with potential M&A? Greg Peters telling Lucas Shaw back in, just 2 weeks ago at Screen Time that they're more builders, not buyers, yet our reporting today from that team shows that, well, maybe they could be interested in Warner Brothers Discovery, at least parts of Warner Brothers Discovery. So if they get a movie studio, how much will they pay for that movie studio? Or maybe this is just trying to bid up the price so other rivals have to pay more.
Maybe they could lean on Mattel for some IP or something. Mattel reporting their earnings just crossing the Bloomberg terminal. Investors don't like it, down about 14%. Let's go right to the outlook. Company still sees fiscal year adjusted EPS of $1.54 to $1.66 a share. Estimate is $1.61. Still sees fiscal year net sales at constant currency up 1% to up 3%, and fiscal year adjusted gross margin of about 50%. The estimate on the street was about 50.3%, but the company says sales dip as tariff uncertainty delays Christmas orders, and that's not a good thing to hear, because you know how much the holiday season is so important to this company, Romain.
Capital One also out with their report as we were speaking here. The most recent quarter adjusted EPS comes in higher than expectations, $5.95. The street was looking for $4.39. Net charge-offs also better than expected, $3.47 billion. The street was looking for about $3.7 billion. So decent bottom line and a slight improvement when it comes to the negative of charge-offs here. We should also point out the company said its efficiency ratio actually widened, I should say, 53.8%.
Yeah, and you can see Capital One shares moving slightly higher after hours. This is a company, too, that had a high bar when you consider that Capital One shares higher by nearly 23% on a total return basis in 2025 through today's close. I do want to circle back to what we're seeing with Mattel, with Netflix. I actually have a way to tie them together. You talk about IP, Carol. Actually, there was a report out earlier today that Netflix has picked Mattel and Hasbro for K-pop Demon Hunters toy partnerships. That's not helping out either stock at this moment right now. And I think, to pick up what you were saying about Mattel, Carol, that to see tariff uncertainty delaying Christmas orders, I mean, this is prime time, obviously, for a toy company, and really speaks to where we are when it comes to the global trade landscape.
Yeah, I mean, listen, you're talking about a toy industry that gets most of its products from China, and that has been, Tim, as we know, a key target of President Trump's tariff increases.
Okay, so other companies reporting too after the bell. Intuitive Surgical, the maker of the Da Vinci surgical robot, shares surging right now, up more than 12% in the after hours. The company sees 2025 adjusted gross profit margin 67% to 67.5%. Third quarter adjusted EPS beat estimates, Romain.
All right. I also just want to very quickly just go to Omnicom, because, of course, we're going to talk a little bit more about Netflix and that build out of its ad platform. Omnicom, one of the biggest ad platforms out there, they reported earnings relatively in line with estimates, $4.04 billion in revenue in the most recent quarter, and $2.24 in adjusted EPS, relatively in line with estimates. But you see a slight tick to the downside in the shares in the after hours.
All right, folks, as we wrap, we've got Mattel certainly dipping big time in the aftermarket. It is down about 20% here as we speak. Actually, now down about 11%. TI is down about 5%. And then, of course, Netflix down almost 6% here in the aftermarket. So a lot for investors to kick around, certainly into the Wednesday trade. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romaine, of course, continuing the analysis on these earnings over there on TV and on the close. And Tim and I continuing on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
And Netflix shares remain under pressure here in the after-hours trade, down about 6% after reporting earnings for the most recent quarter. Lucas Shaw covers this and really the media industry writ large for us out there on the West Coast in Los Angeles. And I know it was just last week or so you had a chance to catch up with the co-president, co-CEO, Greg Peters, Lucas. When you look at some of the comments that he made at your screen time event and you look at what we learned today here, does that sync up?
Yeah, I think they sync up. You have to consider that Netflix's bias is always towards building and doing things internally. And so I would take, though they are interested in looking at Warner Brothers Discovery, or at least pieces of it, specifically the studio and the kind of library of programming, I would not expect them to be racing out making a huge bid for the whole company. I don't think that they're the front runner to get it, but they're looking. Greg, the co-CEO, probably was a little more kind of pessimistic on it than Ted, his kind of partner in crime, the other co-CEO, would be. But that also makes sense because Ted oversees the programming part of the operation, and he's interested in what Warner Brothers has to offer more so than Greg would be.
So we'll have to continue to follow that storyline, of course. I do want to talk about why shares are down 6% after hours right now. When you take a look at the reaction and some of the reporting around this, you point out actually in a Bloomberg News article that there was a tax fight when it comes to Brazil that could be sort of taking the shine off of what otherwise looks like a pretty solid quarter. But give us some context here about how we should be thinking about that and whether or not this is going to be a recurring issue for this company.
Yeah, so it does not sound like it will be a recurring issue. They have had a years-long dispute with the Brazilian government, Brazilian tax authorities, over taxes that companies that are based outside of Brazil but do a lot of business in Brazil have to pay. It relates to, essentially money operating between different divisions of a given company. And they had thought that they were going to kind of win and get away with it because they had a better court ruling a few years ago. There was another ruling over the summer regarding a different company that led Netflix to believe that it might eventually have to pay. And so it's just it's taking a big lump now. And that the sum that it disclosed, the expense of about $619 million, covers 4 years, I believe, 4 or 5 years. So even if they have to pay this going forward, which they may have to, it would be a relatively small amount. We're talking $100 to $200 million a year, which is something that shouldn't affect the earnings of a company that makes as much money as they do.
Just real quickly, Lucas, before we let you go, I am curious about the gaming strategy. I know they've talked a lot about it. I know it's not necessarily material to the bottom line at this point, but do you see them leaning into that further?
Yeah, look, it's a huge question mark. It's one of the biggest divisions of the entertainment business. It's one that Netflix is trying to get into because they see it as important. They have not had a lot of success thus far. Greg Peters gave them a B- at the conference that I hosted, the reference screen time. And they're rolling out more games for playing on television, but I still think most of the people who use Netflix are not aware they can play games, or if they are aware, they're not doing them. And Netflix would like to change that.
Well, maybe people are learning about that for the first time right now. Lucas, great to get you here for some context on these Netflix results. That is Bloomberg's Lucas Shaw, who covers the media industry for Bloomberg News. Let's keep this conversation going now with Sarah Kunst, the founder over at Cleo Capital. She joins us now. Sarah, great to have you with us. You think about Netflix. This is a stock that has really been outperforming, up 39% on a total return basis through today's close year to date. From what you can tell, taking a look at these numbers, have we seen enough to keep this momentum going?
I mean, I just found out that they have games, so apparently they have new stuff to offer customers.
Wait, Sarah, have you not heard of these games? They have Boggle.
Oh.
Pictionary.
Oh, I love
Tetris.
Boggle. I will
Lego
be playing
Party.
that. I'll check it out tonight.
All
But no,
right.
I didn't know.
Don't worry, I haven't played any of them either. So.
No, I mean, I'm a longtime Netflix subscriber, but the reality is that there are kind of other opportunities for customers, right? I just realized that because I'm a T-Mobile customer, I have free subscriptions to Hulu, to Apple TV Plus. So the reality is that most people do have other options. But the thing that really worries me about Netflix just is the fact that valuation sits kind of like when you look at the PE ratio, like an NVIDIA, and I'm just not sure that it's actually a comp for that kind of company. At the end of the day, Netflix is still mostly not a tech company in my mind. So I think it's solid, but I don't know how much room there is to run.
Well, talk me through that, because NVIDIA, you think about why it has that PE ratio, or why people might tell you it has that PE ratio. It's because AI is going to change how we live our lives over the next decade and decades to come. It sounds like what you're saying, that for Netflix, there isn't really opportunity to kind of grow into that PE ratio and justify maybe its market cap.
It's going to be hard, right? It is hard at the end of the day to get, Netflix has very nice margins, but there's a limit on what your margins can be when most of your business is paying people a lot of money to make shows for you. And even if you think that, oh, AI is going to take over all the entertainment and all the actors will be AI, that's going to be true for everybody else as well. And so if the production costs fall everywhere, then being a premium price product like Netflix is in their category probably doesn't make a ton of sense. And so I just struggle a little bit. And this has been sort of Netflix's problem across its life cycle. It is a good, solid content and entertainment company, but does it really deserve to sit alongside tech companies in terms of its valuation, in terms of its PE ratio? And I'm not sure it does.
There's a broader question, though, and it's a great point. But when a lot of people look at that valuation, too, I mean, obviously they compare it to other tech companies, but they also put it up against, I've seen frequently, with the other media companies. And they make an argument here that in terms of the breadth of content, in terms of the stickiness of their subscribers, that in their mind should afford them a higher valuation. Do you believe that?
I don't know how sticky the customer is long term. You're kind of only as good as your last show or as your newest shows. And I think that as the consumer sort of overall tightens their belt a little bit everywhere except the very, very richest people. And one funny thing is you can be the richest person in the world, but you still only need one Netflix login, right? There's not a super, super god tier of it. And so I think that as the sort of rest of consumers see some belt tightening, which we're seeing kind of across the board, you do have to wonder how many will churn and decide that at the end of the day, they're only going to subscribe to one or two. If you have kids, it might be Disney Plus. If you're really into sports, it might be something where you get that some more sports exposure. I don't know that Netflix will win in every single bake-off in every single consumer household. And by the way, while they're a global company, a lot of their global customers don't pay anywhere near as much as we do in the US. So even if they keep a lot of those global customers, they're still paying much less on average than some of those high watermarks that you see in the US.
Your thoughts, Sarah, on the potential for any sort of mergers and acquisitions? Obviously, a lot of speculation about what a lot of people assume is a defunctory sale of Warner Brothers Discovery at some point to someone. Should Netflix actually make a bid?
I think they can. I think that in this environment where media has long been sort of controlled, in terms of a regulatory sense, I don't know if they'll have a stronger bid than Larry Ellison and his family, because Reed Hastings hasn't had the same level of friendship with the president, with DC, and that definitely matters in this environment. And so I don't know if they'll win. I don't know if they want that legacy baggage when it seems like they are really doing an amazing job of making content of their own, but it certainly doesn't preclude them from raising their hand and trying if they have the free cash flow.
All right, Sarah, always appreciate you joining us, particularly on days like today. Sarah Kunst is the founder over at Cleo Capital as we keep an eye on shares of Netflix, which remain under pressure following that earnings report.
Speaking of earnings, we have earnings now coming out of Western Alliance. Remember, this was one of the two regional banks that was really hit with those alleged fraud accounts. You can see, though, that shares moving higher right now to the tune of 3%. Total deposits coming in at $77.25 billion. That is above the estimate of $74.35 billion. Then it gets interesting. You take a look at net charge-offs coming in a little bit higher than the estimate, $31.1 million. The estimate had been for $30.5 $35.4 million. The provision for credit losses coming in at $80 million. The estimate had been for $42.4 million. So certainly above the expectation here. But again, you can see that the shares are moving higher. Total deposits beating estimates. EPS too coming in a little bit higher than the estimate. EPS coming in at $2.28, Romaine.
All right, when we come back, we're going to go back to Netflix. We know they have a big slate of scripted programming like Happy Gilmore, like K-pop Demon Hunters. They got a lot of live events, including Canelo Crawford, as well as NFL games. But what about actual video games? We're going to talk about that push that Netflix maybe is making. Michael Pachter over at Wedbush joins us after the break. This is Bloomberg. Our coverage continues of Netflix earnings, and this time with a closer look at its strategy around video games. It's been a major focal point for the streaming giant, and now for the first time, Netflix is making its video games available for play on TVs instead of just on mobile devices. For more on that strategy, let's bring in Michael Pachter, Managing Director of Equity Research over at Wedbush Securities. And Michael, we were kind of joking a little bit earlier about their slate of games, Boggle, Pictionary, Trivial Pursuit. But I don't know, Pictionary, I mean, if you got a family and you want to gather around the TV, I guess that's as good as gathering around the old school boards that we used to gather around. Is it not?
It is. Look, their strategy is very clearly to offer, games that the lowest common denominator on Netflix want to play. So that's kind of the old Disney Channel strategy, family friendly, only all G and PG rated. But if you look at Netflix, film and TV, they offer anime, they offer documentary, they offer LGBTQ, which each have, niche audiences and appeal to different people. I think the way for them to succeed in games is to do the same thing. And what they found the last couple of years is it's really expensive to do that. So they're going cheap and casual. And I think they're making the mistake of trying to own as much of it as they can. They're kind of not leaning into third-party titles that are available elsewhere. That, I think, is the ultimate solution for them. And they have a really good guy in charge of games. He'll figure it out eventually. But I frankly think Greg Peters might be an impediment rather than the person that's going to get this strategy, ultimately executed.
We'll talk a little bit more about that, particularly on the cost side, because as you know, video games, at least the big ones, are really expensive to produce. We've been talking behind the scenes on the show about whenever GTA 6 comes out, and I think the multiple billions that seem to have spent just developing that. This was never a company that was a stranger to spending a lot of money on scripted TV content. Why do you think they're so reticent to do that with games?
It's born from their absolute fixation on exclusivity. And so the reason things are really expensive for them is because they think if they put a game on Netflix, it has to only be available on Netflix. And that wasn't true with some of their more popular games like Grand Theft Auto. But that's been their strategy on movies and TV. They want exclusives all the time. That's the wrong strategy. Sarah was wrong when she said Netflix is not a tech company. They're very much a tech company. You said in your lead into this piece, they're trying to offer games on connected TVs. That's pretty heavy lifting for tech. I mean, that's really a big deal. And they're going to succeed. I mean, they can do it now, and they're going to do it really well.
Right.
What Netflix needs to do is look at itself the way Apple looks at iOS. Apple doesn't own anything on iOS. No apps, nothing, no games. And yet, that's where all our games are. That's where all our apps are. Netflix needs to think about the platform that is Netflix and add games to it, which means third-party content. Why is Candy Crush not on Netflix? Should be, but it's not. Why is Fortnite not on Netflix? It could be, it should be, but it's not. And I promise you, if Netflix went to Fortnite and to Candy Crush and said, we'll give you the same terms as iOS, they would be there. So once Netflix starts thinking of itself as a portal and it offers to these game companies the ability for people in their homes who don't have a PC or a console to play games on their TV through an internet connection, Netflix wins. They're gonna win.
Right.
And it's because they're a tech company that can pull that off. They just have to think outside the box, and right now they think very much inside the box.
Well, Michael, two things. I believe Sarah's point was just talking about the valuation, that maybe it shouldn't be valued like a tech company, such as in NVIDIA, which of course is not quite single-handedly building out the AI ecosystem when it comes to the globe and specifically to the U.S. But there is the point there that Sarah and others have made that this is kind of an underground sort of thing for Netflix, at least compared to some of their other initiatives. Not a lot of folks know that Netflix does offer video games at all. A lot of people who pay money to Netflix every month. So I feel like one of the issues here is just getting the word out.
I'm going to die on this hill, but Netflix is every bit as much of a tech company as Apple is. So, why do we buy an iPhone? Not because the phone is so cool and cute and takes good pictures, because of the apps. We buy iPhones because of the iOS ecosystem, and Netflix has that. They just aren't exploiting it. So I'll die on that hill. You're right. Nobody knows what they've got because all their games are proprietary crap. They need to offer things we know about. If they just said Fortnite on Netflix, all the kids who play Fortnite would go, oh, why not? How about Roblox on Netflix? They could do that, but they haven't done it yet. How about Candy Crush? All the housewives who play Candy Crush would be all over that. Slot machine games, tons and tons and tons of stuff that costs nothing. The rights cost nothing to them. Apple pays nothing for any of those things, and there are hundreds of thousands of games on Apple. So they'd be on Netflix too. I think these guys win if they ever just look outside of their navels and stop staring at their navels and thinking everything has to be proprietary and exclusive.
All right, Michael, 30 seconds. Is that going to happen, though? Do you think that they will start to license some of these rights that, as you say, cost nothing?
Give it 5 years, yes. They're going to watch this show because, of course, everybody who's smart watches your show. They're going to hear me. They're going to hire me to help them with their strategy, and I'm going to make it happen.
There you go. All right, Michael Pachter, always great to check in with you. That is Michael Pachter. He is Managing Director of Equity Research over at Wedbush Securities. So give it 5 years. That's Michael Pachter's view. You take a look at Netflix shares right now, though, in the pre-market in reaction to those earnings, and doesn't look too hot, down about 5.4% at the moment. Up next, we're going to dig into Netflix's ad revenue numbers with Mountain CEO Mark Douglas. That conversation up next. This is The Close on Bloomberg. All right, welcome back to The Close. We're keeping a close eye on shares of Netflix and also on Western Alliance right now. Both of those companies reporting after the bell today, both closely watched for different reasons. And you can see a different reaction set when it comes to both of them. Yeah, Western Alliance, of course, was in focus. A lot of concerns about what they would report with regards to those charge-offs, relatively in line with estimates. And, of course, Netflix. We've been talking that story all afternoon. Absolutely. And let's keep talking about it with Mountain CEO Mark Douglas, because, Mark, there's been a big focus here on ad revenue. That, of course, is a key line item for the streaming giant. And when it comes to overall third quarter revenue, it came in just shy of estimates. It didn't specifically break out ad revenue, I believe, but it did say it's on track to more than double in 2025. But, Mark, as I understand it, that's off of a fairly low base.
Yeah, so what's happened is Netflix started out, what they wanted at first was the highest pricing in television, and they essentially did not get it. It got rejected by a lot of advertisers who said, look, I'm not paying Super Bowl prices for everyday programming on Netflix. They adjusted, they made changes in their team, and the ad revenue, that reduced the friction, but they are at a point where they're still doing the ad sales kind of old school style, direct deals with advertisers. The new school is it's all programmatic, it's all electronic. It's like doing trading on Wall Street by hand versus having, fully electronic trading. They are building their own ad stack, Netflix ads. It's not done yet. It's not scaled yet. And until it does, their ad revenue is going to grow, but it's going to, be held back because most of the market wants fully electronic ad buying at this point.
Mm-hmm. And when you think about the business model of Netflix, even if, some of what you're talking about when it comes to ad revenue is materialized, if it isn't held back anymore, I mean, what do you see as the future of this company when it comes to balancing subscriptions versus ad revenue? What is going to be the bigger driver here?
Well, I think ad revenue, I think subscriptions is a straight line grower. I mean, there's no current reason to see it slowing down because they made the leap years ago from just being US to going worldwide. And they were one of the, if not the first media company to really do that at scale. The ad revenue, they're signing up users in previous quarters where they were breaking out user growth. They, were saying that more than half of the new users were signing up for ads, but they're not serving ads at the rate that people are signing up, which is bad for this quarter, but really good for future quarters. It's almost like a backlog of potential revenue that once they really scale the digital advertising platform they're building, that's going to produce some really, really strong, it should produce some really, really strong quarters. So, but right now, it's not quite there yet.
Any potential risk that you see right now, Mark, in them not being able to fulfill on that, to execute on that?
Not really. I mean, I think the people who are saying paying for ad free and not seeing that many ads probably are, like pleased, I guess you would say. It's so in the ad business. I don't want you to be pleased not to see them, but I don't really see any risk. And I think like I said, it's a backlog of revenue. It's kind of like the passwords where they were allowing password sharing and then they started to restrict the password sharing and it just grew their revenue. The same will happen, but in this case it'll grow their advertising revenue, which also the thing about that it's so profitable. Like at Mountain, gross margins on ad revenue are like 80%. I mean, for Netflix it'll probably be higher than that.
Oh, wow. Do you think that they will see better success with some of those ad sales on the live programming that they've been experimenting with or on the traditional, pre-recorded scripted stuff?
I think there's insatiable demand for ads on live programming right now, period, just across the industry. And that's something that's relatively new, like I'm talking this year. So yes, and they can charge very premium prices for it. But to really scale it, you have to scale it across the entire catalog, not just cherry picking out certain shows.
Well, Mark, following up on that, I want to return to the point that you made that, when it comes to advertising on Netflix, you said that a lot of these advertisers don't want to pay Super Bowl prices to advertise on a streaming platform. And, I wonder why. Is that just a Netflix issue? Is that industry wide? And I mean, does that perception ever change?
Well, the thing is that makes the only people that are going to pay that are some large global brands who, for reasons they can justify, that's what they want. But again, that gets you to $2 billion in revenue, whatever. It doesn't get you to $20 billion. If you really want to scale, you have to scale the audience, the overall audience, at reasonable prices that work across large global brands, small brands, medium-sized brands. You got to scale broadly. Like they did their customer base, you have to scale the advertiser base, and that doesn't occur at Super Bowl prices.
Mark, always appreciate you taking time for us. Mark Douglas, the CEO of Mountain, there as we parse the ad business, the burgeoning ad business for Netflix.
All right, let's take a look at some of the other after-hours movers today. We're keeping an eye on Texas Instruments reporting after the bell. Their fourth quarter view, it did miss estimates. You can see the stock moving lower right now, down 6.6%, causing a ripple in other names as well. NXP Semiconductors down about 2%. Also On Semiconductor down about 3.8%. So we'll continue to track what's going on with Texas Instruments and all the other earnings up next. This is The Close on Bloomberg. Welcome back to The Close. We are riding a wave of earnings, so let's get you a roundup of some of the notable movers and bring in Bloomberg's Jess Menton, Emily Graffeo, and Norah Mulinda. Jess, standing by with a look at Texas Instruments.
Well, guys, all eyes on Texas Instruments because this is the first major chip company to report during this earnings season. And if you look after hours, stock down about 7%. So even further over of a decline of the one-day move if you look at the SERP function, which was just below 6% here. But unfortunately, Texas Instruments, their outlook for the current quarter was below analysts' expectations, also signaling maybe not as strong of a recovery on the chip side of things. So you are seeing some of its rivals like Microchip and also NXP down after hours, as well as on Semi. So unfortunately, if you looked at its revenue outlook for the fourth quarter, came in between $4.2 billion to $4.58 billion. Those expectations were supposed to be around $4.5 billion. So still not really expecting, especially when you think about what analysts were thinking too. But then also its profit forecast for the first quarter, actually for the fourth quarter rather, was supposed to be about $1.26 a share. Those expectations had been $1.39. So unfortunately, if you think back to July, its stock saw the biggest drop in about 17 years, even though it beat on a number of metrics, because unfortunately they didn't think that tariff-infused, if you're thinking about the sales growth that they had, they were thinking it's going to be more short-lived. So now the big key is what are they going to tell investors and shareholders after hours in this conference call to really shore up some confidence here, because now it's pulling down more of the chip makers. So Emily, what are you looking at?
All right, Jess, I'm looking at a financial company coming after we had those bank earnings just a week ago. Capital One up 3% right now in the post-market after third quarter adjusted EPS did beat estimates. We're getting a little bit of a read here on the consumer, and it is a positive one. Of course, Capital One does have a large consumer business. Those earnings coming in $5.95 a share versus estimates of $4.39. Net revenue also beating, and it was up 54% year over year. The company also said it's authorizing a buyback of $16 billion of common stock. And additionally, this is coming after Capital One acquired Discover Financial back in May. The CEO said that integration continues to go well here. The stock up 21% this year and getting a little bit more of a boost here after earnings. Norah?
Well, I'm looking at shares of Mattel. They are sliding in the after-hours trade, down almost 5% in post-market trading. This is after the third quarter sales and earnings that the company reported fell short of analyst estimates. But really what the headline here is tariff uncertainty. The company is citing tariff uncertainty as really weighing on its production and it's essentially its Christmas sales, which we know, of course, tends to be a very big component here for the company, where they see a lot of their revenue. They're actually going to be scaling back some of their reliance on China moving forward. The CEO said that they expect to buy less than 15% of its U.S.-bound toys from China by the next year and less than 10% by 2027. Of course, we know what this decline that we're seeing right now is essentially evaporating an increase that we saw at the closing bell. This after Mattel and Hasbro announced a partnership with Netflix to produce toys, games, and collectibles for some of its most popular film in history, known as K-pop Demon Hunters. Remain lots to look at here.
All right, a great roundup out of Norah, Emily, and Jess. There some of the other earnings that have crossed the wire here in the after hours traded. Of course, we are focused right now on the streaming space with those earnings out of Netflix, and a lot of speculation right now around Warner Brothers Discovery. Those shares closing out their best day in more than a month as the content colossus weighs a possible sale. Netflix, Comcast, they're said to be amongst interested parties, but our next guest says, well, this might be all about Paramount Skydance. David Joyce joins us right now, senior analyst over at Seaport Research Partners. All right, David, I mean, there's only a handful of companies that, A, could afford to do this, and even a smaller number of companies that would actually want to do this. Is this basically just Paramount Skydance's to have, or are we going to see maybe a meaningful fight for this from some of the other players out there?
I think it might become more than just Paramount Skydance now. I think that the company is looking for strategic alternatives. They're more actively marketing now that they had this press release come out this morning. They're considering another structure related to separating the company as an alternative, whereby they could turn the studios and streamers business into the ongoing company and then spin off the cable networks. I think that a lot possibly has changed earlier today. Netflix in the past, not too recently, or not too far in the past, has said that we've historically been builders, not buyers, but that means historically, and they've changed their tune. So it's possible that things could be coming to a head now. It might not just be the implicit backing of the Ellisons at Paramount Skydance at this party.
I am curious about Paramount Skydance with Warner Brothers content under its umbrella. I mean, some of the criticism, particularly of their streaming service, was that the amount of content was relatively limited. They have a decent catalog, but nowhere near the breadth that we saw with what they built over at Warner Brothers Discovery. If you add that, and then you take into account the live programming that Paramount Skydance has, would that make them more of a formidable competitor to Netflix?
It would get them in that direction, but for the past decade or even 15 years, Paramount Studio has been really in a much smaller scale, which is, to your point, is why their library isn't as vibrant, nor is their production as big. But they do have that relationship partnering with Skydance on some content. But the platform that Netflix has globally, more than 300 million subscribers, means that they can allocate their content costs across a wider array of currently fully engaged subscribers, and that means that if they need to, Netflix can pay up for content rights. So Netflix is still in the leadership positions globally on the streaming side.
Let's talk a little bit about what a potential deal for Warner Brothers Discovery would look like, because you take a look at some of the reporting out of CNBC when it comes to that Paramount Skydance bid, several bids actually, which were rejected. CNBC reported that the highest bid was below $30 per share. You think about where Warner Brothers Discovery shares were before all of this speculation started. They were around $12 a share, right now trading at about $20 per share. What do you think is a realistic valuation for the company at this juncture?
I think a very base case would be $24 per share, but that's really using multiples that don't even reflect where some transactions have taken place. I think it's possible this could see 27 or 30 or more than that if you do have a vibrant auction process that does include the likes of possibly Comcast and Netflix being involved. I think that there's a lot of demand and interest for the Warner Brothers studio because it's been a very prolific producer on the TV or episodic side, and they've also had a historic run this year with their theatrical releases, 8 in a row, doing like more than 40 million and at the box office in the opening weekend. So I think this could become a robust process for that, but the company also needs a solution to monetize or derive the most value from the global network side of the business too. So I think that that there's still some significant upside in Warner Brothers Discovery shares from here, and I don't think you should anchor where it's been in the past year or even back 18 months ago. The stock was in the $6 or $7 range. That was just being kind of left for dead because of cord cutting. And that was when the studio wasn't producing content because of the 2023 strikes that hit the industry. So I do think that recognizing the quality content capability in addition to the library, right, in addition to the global network platform that they have where they could use that as a roll-up vehicle, I think there's still a lot of value to be realized here.
Right. Well, Warner Brothers shares finishing the day 11% higher as this continues, this speculation. David, while we have you, I do want to ask about Netflix earnings outright. This is a company that you cover. You can see shares down about 5% after hours. Their full year revenue forecast did meet estimates. There were some tax disputes down in Brazil. But overall, what do you make of what we heard from Netflix?
I think the stock is overreacting by falling 5% because of the operating income hit. It was a one-time tax dispute reflection in their expenses. The revenues were in line, and the guidance for the fourth quarter on revenues are in line, but they had to nudge down their operating income margin guidance just because of this tax hit. If you take that out, it was a better than expected quarter. So I think that the headline number missing could be providing investors an opportunity to get back into Netflix if they do like the overall story. And I do think that the company is making really good progress on advertising. They're continuing to talk about advertising on more than doubling versus last year, which is roughly in line with our expectations. Again, advertising like subscribers is not a metric that they're disclosing at this point, but I think that the downdraft in the stock right now is probably an overreaction.
All right, David, always appreciate it. David Joyce, senior analyst over at Seaport Research Partners. The share is still down 5%. We should point out right now that conference call, that video interview effectively that Netflix does every quarter, that is now underway. We're going to keep a close eye on that and bring you any breaking news out of it, but also push ahead to an even bigger slate of earnings tomorrow that includes Tesla. A breakdown of what to expect when we come back. This is The Close on Bloomberg. It's that time in the show where we push ahead to what is going to move the market over the next 24 hours. That includes earnings out of IBM tomorrow after the bell. The CEO of IBM actually at the White House right now, Arvind Krishna. They're actually there for a Diwali celebration, but Trump actually praising IBM and the CEO saying that they're investing $150 billion in the U.S. over the next 5 years. You can type live, go on your Bloomberg terminal to continue watching what's going on down there.
Well, IBM reporting earnings tomorrow. So too does Tesla, and Tesla shares up more than 30% so far this quarter. Tomorrow, the EV maker will also kick off the latest earnings cycles for the Mag 7. So here to preview what to expect from that report is Ray Wang, CEO, principal analyst, and founder of Constellation Research. Ray, great to have you with us. So we already had a look at third quarter deliveries. They came out really robust, record deliveries actually, but a lot of that was due to a pull forward potentially ahead of policy changes. So with that in mind, what are you expecting to hear tomorrow?
Yeah, I think there's going to be a lot of conversation about the new Model Y, the 40,000, below 40,000 version, and the new base Model 3. But the short term is really about what's happening on the car side and the energy storage business. They're generating 12.5 gigawatts of energy storage delivery, and that is a good sign because that is the future of Tesla in the short term. In the midterm, we're going to be hearing a lot about robo-taxis and really about that $75 billion market ahead in terms of the TAM in 2030, what people are looking for. And then longer-term growth is Optimus robots, right? This is really what's going to be happening in the future. That robot business is going to be the one thing that's going to separate Tesla from everyone else. That's the physical AI aspect. But in the short term, they've got to keep selling cars to pay for all the future businesses.
I am curious, though, Ray, about how much confidence you have in the execution. I mean, we know they've set some lofty goals, particularly with regards to Elon Musk's pay package. But more importantly, when we start to talk about these robots and the robo-taxis and a lot of these other products, which I guess could be great, do you have confidence that we're actually going to see them to market sometime soon?
Oh, I have a high degree of confidence on the robots. We've seen a lot of the demonstrations of what they're doing on the Optimus robots. That's where you're going to see that. But that's going to take at least 18 to 24 months before we actually see the revenues from them. I'm very confident about the energy storage business because if there's one thing we know from that $5 trillion of foreign direct investment, it's the fact that we're building data centers, precision manufacturing, distribution centers, and of course, a lot of energy. And they're going to need energy storage to keep the base loads that we need to keep AI powering ahead.
So, Ray, I know that you're psyched about energy storage. That's what you have your eyes on. But in terms of what drives this stock, I mean, do you think that the average investor in Tesla, who we know is self-directed, a retail investor, a huge fan of Elon Musk, do you think that they're paying attention, or is this more about robots, of course?
The retail investors are focused on robots. There's a lot of promise getting Optimus robots down to 30,000, getting down to a point where everybody has their own robot. That's where the retail investor is really excited. And I know that's a little bit longer out there, right? Like almost every one of Elon's releases, there's a little bit of time between reality and perception. And what we really want to be able to do is focus on where the revenue sources are in the short term. And that's why I'm actually bullish on the energy side. Is the robots going to differentiate Tesla from everyone else? The answer is yes. And if you look at what it means, it's everything from the automated factories that are coming in place. It's about the ability to look at the replacement labor that's missing in the U.S. And of course, thinking about what we're doing in the U.S. versus China battle on robots.
All right, we have to leave it there. Ray, always fantastic to catch up with you. Ray Wang, the CEO, principal analyst, and founder over at Constellation Research. We should point out Tesla reports after the bell tomorrow. IBM does too. We should also point out that at that Diwali celebration, some of the other notable Indian American CEOs are there as well as the head of Micron, who also talked about his investments in America. And of course, we keep an eye on Netflix as well. Now that conference call underway.
Yeah, absolutely. Netflix shares down after receiving those results. We'll see, of course, maybe if the conference call, if you want to call it that, we'll be able to reverse the trend. But you can see right now down about 5% still remain.
You see Mattel also under pressure, Texas Instruments under pressure as well. I guess the good news is that the market weightings aren't that high for them, but we shall see. Join us tomorrow right here on The Close on Bloomberg.